Thanks so much for jumping in, watching this video. Bob and I just wanted to take 5 minutes here and talk about some of the reasons we love this retail portfolio that we just recently launched, and wanted to give you some inside scoop of why we like this deal. And, when we're looking at deals, and we look at a lot of deals, we always start with the top-down approach. So we want to look at the macro trends and want to see positive movement that is going to support these deals over the long haul. And retail, it's kind of this unique animal because it has some of these we call the meta narratives of retail is dead, and that's been a mantra for many years. But the reality is the numbers say something completely opposite. And so, as investors and value investors at heart, this is something that we love to see when there's a disconnect between what the common narrative and expectation is, but what the actual data is different, especially in this case. So one of the things that we love about these retail deals is it's really simple math, is cap rates, right? And we talked a lot about this in the podcast.
You make money when you buy stuff cheap. And because it's out of favor, because the narrative says retail's dead, when in fact isn't, the stuff is super cheap. So 8.6% cap rate. I mean,
yep.
Unlevered return going in, and that doesn't include the improvements in the value add we're doing. 14 to 17% IRRs and cash flow of 7 to 9%. So this is the inflation buster right here. So this is the great deal. And a lot of people are concerned about recession, and I don't want to get into retail in recession. Well, these neighborhood portfolios are exactly the kind of things that did super well in COVID, which was a horrible, horrible recession. And they literally soared through it. And it's like this. So, and Ben, you were telling me before this, it's, the national tenants are the ones that didn't pay well. It's the little guys,
Yep.
that paid. So are people going to stop getting their dog groomed? Are they going to stop buying their beer after work? Are they going to stop getting their hair cut and their nails done? No, they are not. And those are the priorities. And it's these little tiny neighborhood centers that just do super well. So, and then, I don't know if you can show it. Pull up that little slide you had about the vacancy rates as well.
I'll pull it up. And one of the things that is such a big deal on cap rate, especially going in cap rate being high, that means these properties are cash flowing very, very well. And what's the number one way to withstand any type of recession, right? Most deals that blow up is a lot of times related to the debt, but a lot of times related to inadequate cash flow, right? And when you have cash flow, it kind of solves all these problems.
Right.
And one of the things I love about this portfolio in particular is, I consider this kind of a core plus. And I talk about this in the webinar, kind of the different types of risk-adjusted returns, right? Where you're getting this really great IRR for not taking a substantial amount of risk from a value add perspective to generate the returns that we need to generate and hit the kind of pro forma in our business plan. We don't have to add that much CapEx. It's really going to be
really nice assets in really good location, actually top
really good
little
locations, very, very high median incomes. And it's really converting these leases that were, mismanaged by mom and pop operators from a gross base lease to triple net, which means we're going to be passing on a lot of the expenses to the tenants, which is what the market is, and continuing to boost cash flow by doing that. Let me show this little chart. This is the last thing I wanted to show, but this is my favorite chart that I found recently in the presentation that I did. And so this was from CBRE. This is just released a month or two ago. And you can see this chart on the left here. This is availability of retail square feet over the past 10 years.
So the green line is like the neighborhood community strip center. So you see what's the percent or what's the 12%?
It's going from just over 12% to about 7%. So almost a 50%.
12% of vacancy.
Yes.
To now 8%. No, under 7%.
7%.
Yeah. And by the way, the places we're in are 0% vacancy, and we modeled in an 8% vacancy.
Right. And so you can see here that this trend has been one direction, very, very strong. And part of this is we talked about this on the podcast with Parker recently, is replacement costs to build these neighborhood strip centers has skyrocketed relative to what you could purchase these existing assets for. And because of that, there's not a lot of new development. And so as properties, age out from functional obsolescence, there's not a lot of new properties being created. And as new businesses are being created, there's a reducing amount of supply of availability for these businesses to lease. And so what's that doing? Well, obviously, if you're reducing supply and demand, we all know what happens. Demand is going up and pricing is going to go up. So you can see here on the chart on the right, this is year over year rent growth and just asking rent on a gross basis over the past 5 years. And so it makes sense, right? As you're reducing the supply, the price is going to go up on that existing supply as there's more demand for it. And so what does this all mean? Really to kind of encapsulate it, hey, if we have a little bit of a hiccup in a recession next year or next 24 months, one, we have really good cash flow. These properties are 100% leased in really good submarkets. To achieve the business plan does not require a lot of extra risk from a big capital improvement value add plan. And the longer term trend supporting this asset class in particular is really, really clear. We're very going to continue to drive rent growth for these tenants.
My bottom line is it's the ultimate value play and the ultimate inflation buster. So 2 great ways to win in 2023.
Awesome. Thanks for listening. If this is intriguing to you, please do watch the full webinars. I go into detail on the properties themselves and the business plans. And we appreciate you watching this and jumping in. Looking for passive investments done for you? With Aspen Funds, we help accredited investors that are looking for higher yields and diversification from the stock market. As a passive investor, we do all the work for you, making sure your money is working hard for you in alternative investments. In fact, our team invests alongside you in every deal, so our interests are aligned. We focus on macro-driven alternative investments so your portfolio is best positioned for this economic environment. Get started and download your free economic report today.